So Wells Fargo recently stated that they are backing away from their mortgage company or their mortgage side of their businesses. They are still going to do mortgages, but only specifically for existing customers and people in undeserved communities. Other banks have announced layoffs in their mortgage division, and more banks are coming out with more news about how they're cutting down costs in this division of their whole operation, the mortgage industry. And this is just interesting because don't we still have a supply issue with providing more houses to people who are wanting homes, right? Aren't there a lot of home buyers on the sideline just waiting for houses to actually go on a big discount and for interest rates to look somewhat good so they can afford properties? But yet you have banks slowing down this division of their company, and we have more and more people still looking for houses but are just waiting for things to change. What's up YouTube, it's Matthew here. Welcome back to my channel. In today's video, we're going to talk about how some of the biggest banks are cutting down their mortgage side of their business and what that means for the economy as a whole. Make sure you all like this video, comment down below, and subscribe to this channel for content around the economy, the housing market, and personal finance as a whole. Now, the mortgage industry is a little bit complicated because a big bank like Wells Fargo, they don't only have to underwrite loans directly to their customers, they can sell loan products to third parties. And that's what it seems like they're really trying to concentrate to eliminate those extra, channels that you can make money off of the mortgage industry, and trying to simplify it and just make it direct to their client base. Now, of course, these big banks are slowing down their mortgage side of their business because of interest rate. An average mortgage right now is around 6.5%, and a lot of people are not out getting mortgages as much. And so that's hurting the big business side or the big bank's mortgage side of their business. Well, hurting, I mean, they're still going to profit good. They're still going to make a good amount of money because interest rates can actually help big banks because people are putting more of their savings in the bank because there's a higher yield for savings and money in their bank accounts and whatnot. So that's something interesting that's happening in the big banks, and is mostly spurred by these interest rate hikes that the Fed is doing. Wells Fargo CEO of consumer lending states that we are making the decision to continue to reduce risk in the mortgage business by reducing its size and narrowing its focus. So reducing its size and narrowing its focus. Yes, that sounds great. And I think big banks kind of got too much into the mortgage industry, just made it too complicated, right? This is what they should have been doing all along, right? Just servicing their clients, right? Just concentrating on one group of people who have checking and savings accounts with you, and that's it. Now, I don't know what the other side of it is when they said undeserved communities or minority group businesses or communities. And I know that Bank of America has a product out specifically for people of color or people in undeserved community or low class areas that they try to help the home ownership disparity that exists among races and among different income level group. And so they're continuing with that side. And there's some pros and cons to that too, because I did make a video, if you all check through my channel, of a Bank of America loan product where you don't need the best credit, you don't really need a down payment, and you don't need all the qualifications a regular person would need because they're trying to help this community. But at the same time, you can run the risk of giving loans to people that actually can't afford it, who are not financially literate in order to handle a mortgage. Now, with these big banks making huge reductions in their mortgage side of business, this comes along with firing people, with letting go of people. Now, none of these big banks will just out and specifically say that, okay, because we're reducing the mortgage side of our business, we're going to fire a bunch of people. Yes, they do announce layoffs and things of that nature, but Wells Fargo was a little bit quiet when someone asked them about if that includes, okay, well, this plant right here or this building and headquarters that you use specifically for mortgage companies, are you going to fire most of the people there then? What's going to happen with that place? Now, Wells Fargo's mortgage division is headquartered in Des Moines, Iowa. And in a recent article, I read that with Wells Fargo employing about 13,000 people in the Des Moines metro, many of them at the West Des Moines headquarters of its mortgage division. The company plans to shed $9 billion in mortgage lending. It's not good news. Clearly, Wells Fargo wants to shrink its share of the mortgage business, and that's going to come at the cost of jobs. So these big banks, of course, they want to make their shareholders happy. And so if they're going to announce hey, we're going to shut down this part of our business right now, at the end of the day, they still want to make their profits and make their numbers look good. So in order to reduce a size of one division, they have to cut off labor, right? They have to cut out expenses in another part of their balance sheet, which usually comes in the form of layoffs. Wells Fargo spokeswoman Jennifer Langdon declined to comment on whether the company's shift will impact employment in the Des Moines metro. Wells Fargo cut about 425 jobs in the metro through 2022, according to notices filed with Iowa Workforce Development, the state's unemployment agency. And so here you have people trying to inquire about their jobs probably in this division. Like, okay, what's going to happen here? Yes, we know we still have a mortgage side of the business, but hey, I was asked to work on this side of the mortgage business where you're going to cut off for right now. So am I still employed? And people have already been fired. And so you're going to see more and more of these layoffs happening at these big banks in order to offset their expenses, right? In order to offset that loss they're going to receive on that side of their businesses. Now, just talking about big banks, specifically Wells Fargo, at one point, Wells Fargo was the #1 mortgage company in the United States. Right now, I believe it sits at number 3, most likely behind Bank of America and JP Morgan Chase. But it's interesting to note that Wells Fargo is just always in the news because of fraud and scam issues, right? Recently, I made a video about how they were fined $3.7 billion because of miscrediting or misapplying interest fees and different things to people's checkings or savings account, and also declining or refusing to modify people's mortgages. And in turn, a lot of people lost their house, right? So the #1 mortgage company was doing that. Now they're number 3, which is still super big in America to be number 3. And now they're reducing this side of their business, which is good. It won't necessarily, I believe, harm the average consumer. If they're looking for a mortgage, they can still do it if they're already an existing customer of Wells Fargo. But it's just interesting to note that with all these issues that these big banks already face, they are now talking about this side of the business, just trying to cut costs. And I'm just laying out the information. I'm not saying this is good, this is bad. I see, good on both sides. I see the bad on both sides. So I see both sides to the situation and the story at hand. Now, Wells Fargo's consumer lending CEO states that we are acutely aware of Wells Fargo's history and the work we need to do to restore public confidence. As part of that review, we determined that our home lending business was too large, both in terms of overall size and its scope. This is actually a decent statement to describe this. Hey, we're going in a different direction this year. We don't want to make the same mistakes we did in 2006, 2007 and not stop early before home prices actually crash or get much lower. So we're going to slow down this side of our business, right? We are transparent. We had issues. We messed up before in the past. And this is what we're going to do to change, because we don't want to keep on being in the news because of these different issues. Another bank that is closing their mortgage side of the business, or a part of their mortgage side of the business, is NASB Financial. It's the unitary thrift holding company for mortgage lender North American Savings Bank. And they are now shutting down its consumer direct lending business that originates secondary residential mortgage loans nationwide. So once again, you have another big bank closing down part of their mortgage business. And the thing is, big banks are making tons of money on other sides of their business. Like, for example, personal credit, all right? like credit card. Interest rates are super high right now in that field. And so banks are banking that people unfortunately are not going to pay their credit card bill all the time. And that increases their cash flow. That increases how much money they make on the bank because people are paying back that interest. People are using other products that the bank offers or just keeping their savings in the bank and writing it out. And so that provides more liquidity for banks to use to invest in other areas of their business. Now, Tom Waggers, chief executive of NASB, states that this was a difficult decision, but we believe it is in the best interest of the company given the current challenging market conditions highlighted by rapid interest rate increases in 2022, low or shrinking housing inventory, and double-digit medium home prices. So that's the reason why they're shutting down this business. And to me, this answers the question for all big businesses. But my thing is, how does this affect the average consumer? I think it does affect us because maybe certain people won't be able to get a specific loan because the bank or a lender is not offering a certain type of loan product, or they're not a client of that bank, or things of that nature. But then again, people are not buying as much. Like they say, there's a low supply of houses. People are not buying as much houses, even though there's a high demand. And so maybe they're just shifting their focus to other things because they're seeing, okay, people are renting houses more. Maybe we're going to use this cash to buy houses and be landlords. We never know. So I hope you all enjoyed this video. Be sure to like, comment down below, subscribe, and I'll talk to y'all later.